Good evening, everyone. Can you hear me? Okay. Am I audible, guys? Okay. Thank you.
Yes, Jim.
Yeah.
All right.
Yes.
Okay. I think we can start now. So let me apologize in advance. We are having a lot of a network problem this end. I'm not sure what's happening with my network. I was using Telkom. I had to change to Vodacom because Telkom was not working, but I see Vodacom is also very unstable. But I'm hoping it won't affect our lecture. If it does, my sincere apologies, but I think we'll sail through without any problems. Okay, so my name is James from Varsity Unlimited Tutors. I'm sure a number of you have seen my face before, or we've worked together before when we were doing economics 1A. So I'm back again. I will be the one who will be taking you for financial reporting and analysis. Now, financial reporting and analysis is an accounting subject. So there will be quite a lot of calculations. There will be quite a lot of calculations that we need to do, and there will be a lot of numbers. So I will try my level best to slow it down a little bit to ensure that everyone is on the same page, even as we go through the study module. So before I start the lecture, I will just go over just a couple of semantics, rules, and whatnot concerning how we conduct our lectures, just in case there is someone new who has not done lectures with us before. So all of our lectures are recorded, which means that you have access to the video recordings after the lecture, whether you've attended the lecture or you've not attended the lecture. As long as you are part of the students that are under our purview, you have access to the video recordings of those lectures, which means that even if you say, look, I work night shift and whatnot, you can still have access to those lectures. Then the second thing is concerning the issues of payments and etc. I'm sure, like I said, most of you have worked with me before. You know that I'm a private tutor. I'm not employed by Mancosa. Please, let's make that clear. I'm not employed by Mancosa. I'm a private tutor who just seeks to see if we can help each other out. You make a little payment there. I also now try to ensure that you get your distinction at the end of the what? At the end of the semester through the material that we go through. So for all of what we offer is we are simply offering you some classes, and we're offering you guidance in terms of your assignments and guidance in terms of your exams. So there are 3 different packages that you can take if you want to join with us. The first package, it goes for $750. It is lessons and exam preparation. So the lessons that we do, they also prepare you for your what? For your assignment. Then the second package, it's $950. It's lessons plus exam preparation plus one-on-one assistance with your assignment. I.e., let's say you're stuck with your assignment and you want some one-on-one assistance, you pay an extra R100 for each assignment that we assist you with. So that's the second package. Then the third package, I'm not going to talk about it on this platform, but if you want, you can call me or send me a message. This is basically one-on-one assistance, i.e., outside the class or outside the whole group. If you need some assistance one-on-one, you can also talk and we can get you the assistance that you need. So that's basically in terms of the pricing. All right. Then what are you getting in terms of the lectures? That if you do pay for some lectures, is we usually have about 2 introductory classes that we do where we just introduce the subject. Right. So for example, today we're going to do a bit of introduction to accounting, and then on the next class we meet again, we'll continue with that introduction. So it's just some introductory classes that are free for everyone, even the ones that have not paid. So this also allows you as the student to also evaluate whether you are interested in the classes or you are not interested in the classes, right? So in addition to that, you get lessons on every unit that you have in your study module. So for example, financial reporting analysis, there are 5 units, so you get all lessons on all 5 units that we are going to do. Then in addition to that, you might also get some homework and some solutions to the homework that you do. So this will also help you specifically for accounting. It will help you so that you can also learn to do the calculations yourself in preparation of your exam. Then we'll also do some past exam papers, and I'll provide memos for those past exam papers that we do. Then lastly, I'll provide some tips and group guidance on how you can get a distinction in terms of your assignments, in terms of your in terms of your exam. So that's basically what you are getting for for the amount that you are paying. Right. So that's basically the semantics. I believe that's out of the way. Right. So now let's speak about accounting. So at any point in time, don't worry, I will try to slow it down. At any point in time, if you do not understand what I have said, if you need clarification, feel free to highlight that so that, because I know subjects that are mathematical by nature, if you miss something, it will affect you, because usually the figures go hand in hand. The first figure you calculated is going to affect the next figure you're going to calculate, is an input onto the third figure, and etc. So whenever you feel like you're lost, feel free to ask, so that at least you can get clarification before you are completely lost. So financial reporting and analysis, like I said, it's an accounting subject. Right? So it's a subject that is taught specifically to you guys because you are the future managers. Right? So I might refer you guys constantly as managers within this course, because that's how you need to learn financial reporting and analysis. We're saying that you guys are going to be the future managers of organizations. Now, because you're going to be the future managers of organizations, you need to have a basic understanding of accounting. For you to have a basic understanding of accounting, you need to understand, right, how the accounts or how the financial reports of an organization were prepared, why they are the way that they are, and how to interpret and analyze that information. Right. So in your second year, you're actually going to do a course called management accounting. Now, management accounting is you are now taking this information that we've taught you in financial reporting and analysis, and you're now applying it into your managerial position in your decision making as a manager. But for now, we are not going to go deep into the management part, but we are going to specialize on how were the actual accounts prepared, so that generally as a manager, you should also be able to prepare some rough draft of the accounts of your small organization or of your small department, whatever it is. You should have a basic understanding of what takes place for you to prepare those financial accounts. All right. So what we're going to do today is we are just going to basically give a brief background, i.e. the definition of accounting, the difference between financial accounting and management accounting, common accounting terms, and the accounting equation. So those are some of the things that we talk about. I see someone has raised their hand. I'll come to you in a minute. Let me just finish something here before I attend to you. So in essence, what I'm going to talk about today, it is in your study module, but I'm not going to take the approach where I go unit number 1, point number 1, unit number 2, point number 2. For now, I'm not going to do this. This is introduction. I just want you to have a basic overview. So I'm going to emphasize on certain points that I believe that if you understand those points, when we start going through your study module, it becomes much more easier and much more faster for you to comprehend some of the issues that we will be talking about. Then let me come to the person who has raised the question. You can go ahead and ask. I see there's a hand raised here. Okay, that's right. All right, let's go. All right. So we'll start at the beginning, the definition of accounting. What is accounting? Why do we need to learn accounting? What is it all about? So accounting, usually known as accounting, is basically about the process whereby we measure, we process, and we communicate financial and non-financial economic information about economic entities and business corporations. So you will notice that I underlined certain things here. These things that I've underlined are what are important, right, in your understanding of what accounting is all about. So the first thing that I underlined is measurement, right? So what do we mean by measurement? We are asking ourselves that for you to come up with the financial statements of an organization, the figures that they come up with, right, and say, oh, the company made a profit of this specific value, or the company made a loss of this specific value, or the company made some sales of this specific value. How are those things measured, right? How are those things measured? What assumptions did they use? What concepts did they use in measuring those things? So those are some of the things that we are going to actually learn. I think today we might even touch on some of those things in terms of measuring. Then processing financial information. We are saying that if you were given a set of financial statements, if you were given a balance sheet, an income statement, or all of those different financial statements that you receive, how do you process them? How do you analyze that information? How do you tell whether this company is going to succeed tomorrow or this company is going to fail? How do you tell whether this company has got enough cash to pay off its debtors or it does not have the cash to pay off its debtors? So that's the processing, or what you call the analysis part. Then the communication. The communication was saying, how do you communicate financial information to people? Because remember, as a manager, you need to communicate financial information to your employees. You need to communicate financial information to the owner of the company. You need to communicate financial information to the tax authorities, to the government, right? You need to communicate financial information. How do you communicate it? How do you present your financial information? What is acceptable in your presentation? How many financial statements should you present? Is the income statement alone enough? Is the balance sheet alone enough? Should I present 3, 4, 5 different financial statements? What should I do? So that's the communication part. Then the last part is the economic entities. Economic entities, we are saying that not all businesses are the same. So if you look at your study module, for example, if you look at the table of contents in your study module, it will tell you that unit number 1, it will tell you that understanding financial statements and something like that. Unit number 2, it will tell you sole traders. Unit number 3, it will tell you partnerships. Unit number 4, it will tell you companies. So you can see that those are like different types of economic entities. And each type of economic entity or each type of business has got a different set of rules when you are presenting your financial statements. They are similar, but there are slight differences that you see. So you also need to understand what those slight differences are so that you have what? You have a better grasp of which financial statement should I use if I am a sole trader, which one should I use if I'm operating as a partnership, or which one should I use if I'm operating as a what? As a company at the end of the day. So that is the definition of what? Of our accounting. That is what accounting is all about. This is what we'll be doing for the rest of the what? For the rest of the semester. Then the second thing that I need you guys to understand, right? This is now the difference between what you call financial accounting and managerial accounting. So like I highlighted in my introduction, you are going to do in your second year a course called management accounting, right? So for this particular course, we are focusing more on financial accounting rather than on management accounting. So we are not going to go into detail about this, but I just need you guys to just have a basic understanding of those key differences, because I've noticed that specifically in your assignment, the assignments that you're going to give, sometimes your lecturer can ask you, what is management accounting, or what is financial accounting, or what is the difference between the what? Between the two. So when you're looking at management accounting or managerial accounting, you're looking at financial or accounting information that assists managers to make decisions. But when you're looking at financial accounting, you're looking at financial or accounting information that is used to be presented to anyone that is not within the organization. So anyone outside the organization gets financial accounting. Anyone within the organization gets managerial accounting. Why? Because managerial accounting is for decision making. It is for managers. It is looking at the future of the organization. Where is the organization going to what? Going to go. But financial accounting, which is what we are doing in this semester, is now concerned about reporting past results what happened during the last year, what was our revenue in the last year, what were our costs in the last year, what was our profit in the last year. So you will notice that financial accounting, because it is more emphasizing on the reporting part, hence financial reporting in the analysis, there is a lot of standards, there is a lot of frameworks that are used to make sure that you do it correctly. Right. So we will talk about GAAP, we talk about all these institutions that help accountants to present the what, to present the information. So that's the difference between the two. So we've talked about the what, the definition, and we've talked about the what, we've talked about the differences. Now, if you go into your study module, you will notice that there's a lot of theory. We don't worry about the theoretical part. We'll come back to it. We'll come back to it. But if you look at the almost at the end, there is, I think it's unit number 1.7 on your first unit number 1, where it says classification of financial information. So I want to talk a little bit about that today. I think this is where my main focus is going to be, classification of financial information. Now, the reason why I want to focus on this today is so that whenever we now talk going forward, you will have a better understanding. Because I'll be talking about assets, I'll be talking about liabilities, I'll be talking about income, expenses, revenues, and whatnot. But if you've never studied accounting, you will be wondering, what is this guy talking about? So here I'm just trying to give you some accounting terms that you need to understand for you to have a grasp of what I'm actually, what I'm talking about. So once we're done with this, we now go into the different financial statements that exist, and then we can now go into the actual theory that you can see in unit number 1. So there are 5 key terms that you need to understand when you're doing accounting. You need to know what is an asset, you need to know what is a liability, you need to know what is equity, you need to know what is an expense, you need to know what is income. These 5 items are the building blocks of all the financial statements that we are going to be talking about, of all the analysis that we are going to be doing during the semester. So these 5 things are the building blocks. Your understanding of these 5 things will make your job, you make everything much easier for you. So I don't expect you to completely understand everything right now, but at least if you pick up some of these things, when we get to the individual aspects of it, you understand them you understand them better. So let's start with the first thing. What is an asset? When we're talking about accounting, what is an asset? Now, by definition, an asset is basically a resource that you have as an organization. A resource, what is a resource? A resource that gives you an economic value to the company. A future benefit will be derived from that resource. So for an example, right, if you have a delivery company, right, you can say the delivery vehicle, the motor vehicle that you have is an asset. Why is it an asset? We are saying it is a resource, number 1. Then number 2, we are saying there is future value that we can derive, or future benefit that we can derive from it. We're saying that in a week's time, in a month's time, in a year's time, in 10 years' time, this delivery value will take our customers' goods and move them from point A to point B, and the clients will pay us money for doing that. Therefore, it is an asset that is going to give us money into the organization. So that's an example of an asset. So there has to be a future income or a future gain when we are talking about an asset. We're not talking about something that you are consuming right now, but we're talking about something that we are saying that in the future, as you consume this thing, it is going to benefit the organization. So for example, if you are Coca-Cola, you can have a plant and some machinery that you use to bottle your Coca-Cola drinks. So we are saying that next year, you're going to use that plant and machinery to get some Coca-Cola drinks, and you're going to sell them, and you're going to get a profit. So that's another example. Or let's say you are Apple, the phone company. You can have what we call a patent. A patent is whereby you're saying there's some intellectual property or some thinking that was done by someone, and you go to the government to say, this is my idea. If anyone else uses that idea, that's a patent. If anyone else uses that idea, they have to pay you money for it. So that's an asset. We're saying that it's a resource that you own, but we're saying that this resource, when it's used in the future, you are going to be paid for its use in the future. So that's again an asset. Inventory, stock, like let's say you're Mr. Price, the clothes that you are selling are also an asset. If you don't sell them right now, you are saying that next year, these clothes that are in our store, if we sell them in 2022, in 2023, sorry, we are going to sell them next year and we're going to get money from them. They become an asset because their value is going to be gained in the future for that part, for that resource. Right? Someone who owes you money, a person who we call a debtor, right? If someone borrows money from you, right, and they owe you money, they become an asset. Why? Because we're saying that it's a resource that you have that in the future, whenever they pay, in the future, whether it's next year or next year, but whenever they pay you, you're going to gain a benefit from them. So that becomes an asset. So I'm sure that that's now very clear what an asset is right? Right. So an asset can either be fixed or it can be current. So we refer to them as non-current asset or fixed assets, or we refer to them as current assets. So that's the division. It can either be fixed or it can be what? It can be current. So when we're saying an asset is fixed, we are saying that the asset is illiquid. We are saying that you cannot easily convert it into cash. That's what we mean when we say an asset is what is fixed. So for example, a building, if an organization owns a building, the building is an asset that is a fixed asset or a non-current asset. They cannot easily convert a building into cash. But in some organization, right, can have physical, right, cash that they have. They can have physical cash that they have, which they can use in the future to gain some money back. So that's a current asset because it's already liquid, right? Or some stock, we were talking about Mr. Price. They can easily put the stock in the shop. They can put a price there. Some people can come and quickly buy the stock and it becomes a what? It becomes a current asset. So if you can easily convert the asset into cash and you can convert it within the same year, right? So we're saying that you are preparing some statements, right, at the end of the year. We're saying that within the next year, I am going to convert this into cash. It becomes a current asset because we're saying that in the immediate future, this will be converted to cash. But anything that goes beyond a year, we are now saying now that is a fixed asset because we're saying that you are not converting it into cash anytime soon. Another thing that you might notice is there are what we call tangible assets and intangible assets. Tangible assets are assets that you can actually hold. Your building, your vehicles, your laptops, your office desk, your furniture and fittings, and etc. That's a tangible asset. An intangible asset, we are basically saying it's an asset that you cannot hold with your hand. So for example, the patent that I was talking about, that's intellectual property. You cannot physically hold that this patent is what I have. It's an idea that someone is certified that no one else can use. Or what we call reputation, goodwill. It's another asset. We're saying the goodwill of the organization can be regarded as an asset that will gain the future income, right? That's the goodwill of it. But you cannot hold goodwill. You cannot hold the reputation of an organization. So it becomes an intangible asset. So those are some of the clarifications that you also might need to understand. So what I have done over here is I've given you guys this. I'll highlight it in yellow here. I've given you guys this list of different assets, right? And I've given you a little homework that I want you guys to do. So if you face any difficulties, when we meet next time, you can highlight where you face your difficulties and I can explain further. So you are supposed to take all of these assets that I've listed here and you're supposed to complete this table, right? So for example, I'll do one for you just to show you what I mean. So for example, over here, I can take the asset of what? I can take the asset of stock or inventory, right? So what is stock or inventory? So I can come here and say inventory, right? And say description, what is inventory, right? These are goods held for sale by the what? By the organization. Are they current or are they non-current? These are current because we're saying that we want to sell them within 1 year. We don't hold stock so that we can sell them 10 years later. We want to sell it within what? Within 1 year. So we are putting it under current. So I would want you guys to do the same thing for all the remaining assets that I've listed over here. Right? So this will also help you to see which assets do you understand and which assets do you not understand. So that even when we meet next time, I can then explain to you if there is a single asset that you don't really understand how that is an asset, or whether it's current or it's a non-current asset. So that even if you meet it in an exam situation, you'll be able to allocate it appropriately, whether it's a current asset or a non-current asset. So that's on assets, right? So remember, there are 5 things. We've now done assets. Let's go to liabilities. Okay, what is a liability? Now, a liability is basically something a person or a company owes you, right? So we are basically saying if you owe someone, right? If you owe someone money as an organization, right? Or as a sole trader or as a partnership, right? If you owe someone money, it becomes a liability, right? It becomes a liability to you, right? It's just English. It becomes a liability to you. So a liability by its very nature, right, is, remember what I said, when we're talking about assets, we're talking about the future. There is a future economic benefit from an asset. There is a future economic benefit. The same thing also applies to a liability. We are saying there is a future economic loss or loss of value. So the reason why I'm emphasizing future is, you notice when we talk about income and when we talk about expenses, we'll no longer be talking about the future. We'll be talking about the current, right? So when you're talking about your liability, you're talking about future loss of what? Of value that can happen to you as an organization. So for example, if I take a loan from a bank, the bank gives me 500,000. This means that maybe in 6 months' time, maybe in a year, maybe in 5 years' time, I have to pay back the money to the bank, which means I have to lose value. I have to lose 500,000 from the company back to the bank. So that's what I mean when I say future loss of value. So I've given you a couple of examples of what are liabilities, examples of liabilities. But let me just pick 1 or 2 to explain them. Right? So bank loan, I think that's very straightforward. A debenture, right? A debenture is just like a bank loan, but you're not taking the loan from the bank. You are taking the loan from the stock exchange. I'm sure some of you know the Johannesburg Stock Exchange, the JSE. Right. So we're basically saying that if you go to the Johannesburg Stock Exchange and you say, I want to borrow money from the public, you borrow that money through a debenture or through a bond. Right? That's what you want. That's what you do. So that's what a debenture is. You're just borrowing money from the public through the stock exchange. Right? Then the next one, mortgage. I'm sure you all know what a mortgage is. You want a house, you want a building, you go to the bank, they facilitate a mortgage for you. Right? And then let's see something that we can pick up here. Okay. Some of these things we'll explain them further when we do the financial statements, right? So accrued expense, let's talk about accrued expense. What do we mean by accrued expense? Why is this a liability to you? So we're saying that as you operate as an organization, so for example, let's just talk about you yourself, right? If you use your water for the month, right? If you're not using prepaid water, if you use your water for the month, the bill will come at the end of the month, right? But you've already used the water, which means that the water, when you go to pay the bill at the council, you're not paying for water that you're going to consume in August. You're paying for water that you already consumed in what? In July. So the same thing also applies to the company. The company can use water for the whole year and never pay the water. So when they get to December, they receive a bill from the city council and say, can you please pay for your water? And then they pay for the water in January. But it does not mean that the expense that the company is having is for January. It means that it was for the last year. Right? So in your financial statements, if you have an expense that you have not paid for, but you have already enjoyed the benefit, you are saying that in the future, we have to pay for what we enjoyed in the past. That's an accrued expense. That is a liability to the what to the organization, right? So that's what an accrued expense is. Right. So, like I said, some of these, don't worry, even if you don't understand them clearly right now. When we do the financial statements, I'll also explain some of them point by point as we get more examples and etc. But I just want you to understand what a liability is. Right. So those are liabilities. Liabilities can be non-current or can be current. They can be non-current or current. Non-current, we're just saying they're long-term. They are more than 1 year. So when anything is non-current, whether it's an asset or it's a liability, we are saying that its period is for more than 1 year, you are not going to pay it, or you're not going to receive anything for it for the following year, right? So that's non-current. Then if it is current, we're saying it is short-term, which means that if we say that a liability is short-term, we are saying that within the next 12 months, we are supposed to pay that liability off. Within the next 12 months, we are supposed to pay that liability off. So this actually means, if let's say I take a 5-year bank loan, right? If I take a 5-year bank loan and I'm supposed to pay 1 million per year, right? So let's say that it's for 5 million. In my recordings, initially I can write that the long-term loan is 5 million, is non-current. But each and every I have to adjust, because I'm saying that within the next 12 months I have to pay 1 million, which means that a portion of that loan becomes current, while the other portion remains long-term. So those are some of the nitty-gritties that you see, right? So again, I did the same thing. I've given you here a list. I've given you a list of liabilities, right? That I want you to group under Under let's see, under for liabilities, just a non-current and current. There's no tangible. Let's remove that here. So I want you to group them under, is it a current liability? Is it a non-current liability? And also, what is the description? What is the definition? So that you see if you understand it or not. So that if you don't understand it, then when we meet next time, you can actually ask a question. Look, I don't understand this one, which you called, let's say, dividend liability. I don't understand it. What are you trying to say? But let me explain what dividend liability is. It will probably open up your mind. So at the end of the year, once you've declared the profit, we are going to also declare a dividend and say we are going to pay our shareholders this much in profit. But you are speaking it. You are saying we are going to. You're actually not paying them there and then. We are going to in the future, which means you now owe the what? You now owe the what? The shareholders a specific dividend. Whether you pay it in February or in March or in August next year, that's not the point. But you are saying that you are not paying it today. You have just looked at your accounts, you have seen that there's a profit, and you have promised them that we are going to pay you a dividend. So that's a dividend liability. That's basically what that statement means. So those are examples of liabilities. Please, in your spare time, just go through them, try to see if you understand each and every one of them and group them respectively. If you don't understand any one of them, feel free to ask either in the group or in our next class. You can ask, look, I didn't understand this one. Can you explain to me what it means? So that's a liability, right? We go to the next one, income and expenses. Remember, we said that there are 5 things, right? We've talked about what do you call it? We've talked about assets, we've talked about liabilities. Now we want to talk about income and expenses. So what is income? Income now is the increase in benefits that arises on a daily basis at the company. So as you operate your company, as you operate your small business, if you gain some money, right, from your activities, then that becomes the income that is coming into the business. So income usually comes in the form of, probably you've sold your assets as some of the assets that you, for example, your stock. If you sell your stock, you can get some income from your stock. Or there's been an improvement in your assets. So your assets, the value of your asset was 100 Rand today, but at the end of the day, it's no longer 100 Rand, it's now 150 Rand, which means there's been improvement in the value of the asset. That can also be regarded as as income. So income can be seen, for example, it can be sales, like the stock that I was saying. You sell your stock, you get sales, that's income. Maybe you own a building, you get rentals, that's income. Maybe you own some foreign exchange, you own some US dollars, or you own some British pound, and there's an appreciation in the value of the US dollar or British pound. That's again income that you've gained. Or maybe you have a financial security, you have some shares for Vodacom that you have as a business that you are keeping. If the share price goes up, that can also be considered as an income. So income can be realized income or unrealized income, but for the purposes of this module, we're not going to go too deep into that because that's now pure accounting, but we don't want to talk about that. Right? Then expense, what is an expense? An expense is just the decrease. Now, the depreciation in the value of your assets. We are saying that you had an asset, for example, let's say that you've got the asset of cash, and you pay your rentals using the cash, which means that rentals becomes an expense. Let's say you've got the asset of a building, and at the end of the year, the building is no longer the same because you have used, for example, even a car. You have used the car, there's no mileage in the car, so we depreciate the value of the car. That's another expense that you're talking about. So any decrease in the value of your assets, right, is regarded as as an expense. So the difference now between assets and liabilities and income and expenses. In income and expenses, we're talking about the immediate inflow or outflow of the value. Whereas when we're talking about assets and liabilities, we're talking about the future benefit that you're going to be deriving from something, right? Or the future loss that you're going to be deriving from something. So again, same concept. I've listed here a lot of different expenses and incomes and a couple of assets and liabilities. In your own spare time, you can just go through a number of them and see if you can allocate them. I've given you a table here: name, description, category, right? Does this fall under assets? Does this fall under liabilities? Does this fall under expenses? So these exercises that I've given you, they are just meant to open up your mind to see the different terms, because we're going to be talking about all of these things that you see here. We're going to have a lot of examples. In some of the examples, you have legal fees, you've got property tax, you've got rentals, you've got bad debts, and all of these different terms that you're going to see. So you need to have an understanding of what each of these things mean. Right. So, but like I said, you don't need to worry that much, because like I said, each and every lecture as we go, you will meet some of those things and I'll explain them as we go. But it would be good for you if you can at least try at this juncture so that you know what is going to give you problems, so that we can address it even now at the very beginning. So please make sure these little homeworks that I've given you, make sure in your spare time, you just go through and try to allocate into different things. If there are any problems, you can ask, and then I'll try to help you out so that you can easily understand what is an asset, what is a liability, what is an income, and what is an expense, so that it becomes easier when we do the financial statements, right? Then, okay, there's one thing that we haven't talked about here, or there it is, equity, right? So that's the last one. Remember, there were 5 of them. There were assets, liabilities, income, expenses, and then the last one is equity. What is equity? Equity now, we are saying this represents ownership in a company, right? If it's a company, or if it's a partnership, or if it's a sole trader, this represents ownership. If you own something, which means it's yours. But when we talk about ownership, we first deduct what is not yours. So for example, if you have a company, your company, let's say, has got a building, right? 100,000, that's the value of the building. So you're saying that your company owns the building, which means that you are saying that, oh, this building belongs to me. But if you bought that building using a loan of 3 million, it means that 3 million is not yours. 3 million belongs to the bank. You have to pay back the bank 3 million. So equity, we're saying it is the stake of the owner in the company after deducting all other claims, which means after deducting all liabilities, what you owe to other people. So once you remove what you owe to other people, then you can talk about what? Then you can talk about equity. So there's something that is called the financial accounting equation that we're going to talk about. It's going to clarify about these things to you. Right. Then this homework here, this one is not important even if you know it for now. It's not important. It's more important when we finish the module, right? You will need to understand it. But just for your consideration, when we talk about equity, there are certain things that you notice that we'll start talking about. We start talking about ordinary shares. We start talking about preference shares. We start talking about capital accounts, current accounts, drawings, retained earnings, capital reserves, etc. Right? But for now, don't worry about this. This particular homework, you can ignore it. Don't worry about it. I would want you to answer me these questions when we get to the end of the semester, because you will now have an understanding. Or ordinary shares, we're talking about the company. Or capital and current account, we are talking about what? We're talking about partnerships. Or drawings, we are talking about a sole trader and some of that stuff. Because it's all different depending on what you are dealing with at a particular point in time. So this brings me, I think, to the end of what I really wanted to do today, but let's see how much time we still have to see if we can proceed. Wonderful. Hello, guys. Hello, can you hear me?
Yes, we can hear you, James.
Okay.
Yes, we can hear you.
For that, I think my network here today is just acting up. Okay, just give me a second here. Let me try to set it up again. All right. Okay. Okay, just give me 1 second here. All right, am I audible? Hello?
We can hear you.
All right, cool. All right, so I think we still have like 15 more minutes. Let me proceed, I think, to the last one here before we go to unit number 1. All right, it's fine. I think that's good. All right. So the last thing that I will do for today is we'll talk a little bit about the accounting equation. So like I said, you will notice that if you go through your unit number 1, the things that we've talked about here, they are there in the unit number 1. They are just not the first things that you learn when you're doing accounting. But the reason why I started with them is it makes it easier to explain some of the stuff that I'm going to explain later. Because if you have the understanding of these things, then it becomes easier when I say, this is an asset, or when I say if the asset value increases, when I say if the liability does this, then you understand, oh, this is what it's talking about. This is what it's talking about. So the accounting equation. Now, the accounting equation is the basis of everything that we are going to be doing. It again reflects back to those things that we talked about, those 5 things: the assets, the liabilities, the income, the equity, and the expenses, right? That's the accounting equation. So the accounting equation simply states that for you to calculate the assets of the company, you have to take the equity and add the liabilities. So if you say equity plus liabilities, you get the assets of a company. So whenever I say company, I'm not just talking about a company, I'm also talking about partnerships. I'm also talking about sole traders, anyone who's in business. It's just a term that's a company, right? So what does that mean? What are we trying to say? We're saying that, for example, what you have as an individual or what you have as a company is based on how did you buy it. Did you use cash to buy it? So you add the cash. Did you use a loan to buy it? So you add the loan. So if you have a house for 100,000 and you bought it 50% cash and 50% a bank loan, this means that it's 50,000, 100,000, which is the house, which is the asset, is equals to the 50%, which is 50,000, which is equity, which you contributed, right? Plus the 50,000 from the bank that you received. So the 50 plus the 50 gives you the 100. So that's what we are saying. That's how simple it is. We're saying that the value of the company or the value of the business is equal to how was the business financed, how much equity, how much did the owners put into the business, and how much loans, how much liabilities, how much did the owners borrow for them to start the business. So that's the accounting equation. So you can see over here, I've got a little example that I've provided over here with the accounting equation, where I've said that if you have a house, right, so this is not 100, this is 1 million. Well, I said that if a company is in real estate, let's say you've started a real estate company, right? You've started a real estate company, and the company is got a house. They bought one house. That's their first thing that they bought is a real estate company. But how did they get this house? They used 100,000 cash, which belonged to the owner of the business. He had 100,000 in the bank account. So he said, oh, look, I'm going to deposit this 100,000 for the house. And then they went to FNB and got 900,000 bond mortgage loan that they got from what? From FNB. So this is the real estate company. They've bought one house. They've used 100,000 in cash, and they've borrowed a mortgage for 900,000. So if you're saying, give us the accounting equation for this business, you're going to say, what is the asset of the business? The asset of the business is the house. And what is the value of the house? It's 100,000. Sorry, it's 1 million, right? Rand. That's the value of the house. So it's 100,000 is equals to what is the equity of the business? How much did the owner put into the business? You can see that the owner put what? Put 100,000 into the business. That's the money that they had in the bank account. So the 100,000 that the owner put into the business plus the liability. What is the liability? The owner borrowed from F&B 900,000. So we're going to add the 900,000 borrowed by the owner from what? From F&B. So we get the accounting equation. 1 million is equals to 100,000 plus 900,000. So you can see if you add 100 plus 900, what does it give you? It gives you 1 million, which means that it's 1 million is equals to 1 million. That is balancing. So you will notice quite a lot in accounting. We will talk about the double entry system. We'll talk about your balance sheet should balance. We'll talk about your cash flow statement should balance. We'll talk about a lot of things about balance.
I'm listening to me, baby.
We'll talk a lot about balancing and whatnot. This is where it is coming from. We are saying that no matter what you do in accounting, there are two sides of everything. This is what is called the double entry system. There are two sides of everything that you do. Right? There is the asset side, and then there is the equity and liability side. This equation, you can change it if you want. You can say assets, right? For those of you that have done algebra, I hope I won't confuse someone here. For those of you that have done algebra, you can say assets over here, right? Assets. Let's move liabilities from the side of the equation where it is to the other side. It becomes negative, right? We say minus liabilities is equals to what? Is equals to equity. Remember the definition of equity that we're talking about. What did we say equity was? We say that equity is what the person owns after removing all loans, after removing all liabilities. This is where the definition is coming from. We're saying equity is equals to the assets less the what? Less the liabilities, right? So that's what we're basically saying, right? So you can move around this equation. You can also say liabilities is equals to what? To assets less equity and whatnot if you want to do that. But basically it's just assets is equals to equity plus liabilities. So that's the what? That's the accounting equation. Now the accounting equation. This is now a popular question with some of your lecturers. They like it. They want to see if you understand the accounting equation and whatnot. Right? We're going to be doing some of these things after about unit number 2 or 3. You won't even be bothered by these things. You will know them. Don't worry if you don't understand what we're going to do. But the accounting equation can change over time. But even as it changes, it should always balance. No matter how it changes, it should always balance, right? The assets should always be equal to the equity plus liabilities, no matter what changes. So let's go back to our equation, right? We've got 1 million is equals to 100,000 plus 900,000. 100 plus 900, it's what? It's 1 million, right? So let's say you as a business, right? Let's say you as a business, you decide, I want to sell this house. That's what you decide. I want to what? I want to sell this house. That's what you've decided as a business, right? So what are you going to do? You're going to go to Gumtree or you're going to go to private property and you want to list an advert. They're going to charge you, right? They're going to charge you for the advert. Oh, the advert costs you 1,000 Rand for you to put your advert in our paper. So you have to pay for the advert. So what do? You use your own cash as a businessman. I'm going to use my own cash to what? To do this advert. So how does this 1,000 now affect the accounting equation? Now, listen to me carefully. So we are saying that you as a business, what you have simply done here, 1,000 is an expense, right? 1,000 is what? Is an expense, right? 1,000 is an expense that you've incurred as a business. So what is the impact of an expense? The impact of an expense is it reduces from the what? From the business, right? But this expense, how have you paid for it? How have you paid for this expense? You've paid for it through equity. Because we're saying you are using your own cash as a businessman, right? You're not using the cash of the business, You're not using the cash of the bank, but you're using your own cash. So we're saying that what is going to happen to this accounting equation over here, we're going to say 1 million, right? The house is still there. The assets have not changed, right? But we're saying that as a business, you have what? You have added equity, because you are saying that you have taken your own 1,000 and you have added it to the business. So you have added 1,000 into the business as equity, right? But also you have paid that 1,000 to someone else, which means that you have subtracted 1,000 as an expense, right? Because expenses affect the equity of the business, right? And then the loan still remains the same. If you add this up, it will still give you 1 million, right? Because it's 100,000 plus 1,000 minus 1,000 plus 900. It will give you 1 million. So you notice nothing changes. Everything still remains the what? Everything still remains the same. You're still saying you are balancing. The equation does not change. It's still balancing. Let's go to the second one. You decide that they want you to pay some rates. Because it's a house, you have to pay some rates to the council. They want you to pay 5,000 in rates. That's the council, right? So how do you pay the 5,000? You say, let's take it from the business account. But there's no money in the business account. There's no cash, because remember, you used all of your cash to buy the house. So there's no money. So it means that FNB gives you an overdraft, right? They say you can overdraw your account by the 5,000 that you want to pay the rates with. How does that affect your equation? Again, the house is still there. No, your assets are not affected. Let's go and see how is this affected. So you're going to say the 100,000 in equity that you had before, and remove the 5,000, which is the expense, because you're saying the rates are expenses to the organization, because you're paying the cash right now to the council, city council, right? So that's an expense. So you remove your expense, right? Then plus 900,000 you owe FNB. But now you owe them an extra 5,000. So you add the extra 5,000 there. If you add this up again, it will give you 1 million. So you notice your 1 million is equals to 1 million, still the same. Nothing has changed. You're still what? You're still balancing, right? Let's look at the third one, right? I sell the house. You're now selling the house now for 1,500,000. Right? That's how much you sold the house for. And how much did you get? You got 1,000 in cash, and then 500,000 will be paid in 2 months. So what has happened now? We are saying that the house is no longer there, right? The house is no longer there because you have sold it. But what assets have replaced the house? You know, I've got what? 1 million in what? In cash, right? You know, I have 1 million in cash that the buyer paid. And the buyer said that they will pay you 500,000 in what? In debtors, right? So that's a loan that you've given the buyer. So they're going to pay you maybe in a couple of months, 500,000. So that's an asset. We call it accounts are receivable or debtors. That's another asset that you now have, right? Is equals to, you can now see on the other side, it's now 1.5, but it has to balance. So on the other side, it also has to be 1.5. How so? We're saying that you had 100,000 in what? In equity. But you have now made a profit. Because remember, the house was 1 million. You bought the house for 1 million, but you said it for 1.5, which means you have made a profit of what? Of 500,000. So to your equity as the owner, you have now made an extra 500,000 here. And what happens to FNB? FNB, you still owe them because you have not yet paid FNB, right? So if you add this up, you still balance. But now it's now different. You're now balancing with what? With 1.5. You're now balancing with what? With 1.5, right? So you're still balancing, but you're now balancing with 1.5. So this is just basically the accounting equation. Like I said, even if you don't understand some of the things that I've done here, don't worry about it. You understand it with what? With time. I just wanted to show you what I mean when we say everything has to balance, right? So when we go to the balance sheet, when we go to the income statement, when you go to the financial statements, you'll notice that we'll talk about it's not balancing, which means that maybe there's a mistake that we've made, maybe there's something that we did not understand, because at the end of the day, your financial statements, specifically the balance sheet, has to balance, specifically the income, the cash flow statement also has to balance at the end of the day, i.e. assets should always equal the equity plus the liabilities of the what? Of the organization, right? So you can see even the last 1 year, I said that you pay back the bank the 900,000, right? So if you pay back the bank, you reduce your cash, and also it's going to affect your what? Liabilities are going to be reduced at the end of the day. So these are just examples of how the accounting equation can be affected by the different transactions that happen. So your lecturer, what he usually does is he will give you a scenario and ask you, what does this affect? Does this affect the assets? Does this affect the equity? Does this affect the liabilities, right? So any expenses and any income, it will affect the equity. So if there is an increase in profit, you add to the equity. If there is a loss of value in expense, you subtract to the what? To the equity of the organization. But the remaining one, these ones you already know them: assets, equity, and liabilities. The only thing that you don't see here is the income and the expenses, but they all come under equity: the income and the expenses. Income adds to equity, expenses subtract from the equity of the organization. So this brings me to an end of my introduction to accounting. Now, in my next lecture, we are now going to go into your study module, which is now unit number 1, where we are now going to talk about the role of financial statements, the users of financial statements, general accounting standards, the value and limitation of accounting statements, characteristics of good financial statements, classifications, and summary of the various financial statements. So that's what we're going to be doing in our next class. Again, the next class is going to be free. Don't need to worry about paying. Like I said, it's at least 2 free classes. So now you have a basic understanding of what is accounting, right? Of the difference between, let me do this so that you can see what I'm talking about. All right, of the difference between financial accounting and management accounting, of the common terms used in accounting, which is assets, liabilities, income, expenses, and equity. Those are the common terms that I'm talking about, right? You also have an understanding of what is called the accounting equation. The only thing that we do not talk about are the T accounts. These ones I'll reserve them for another time. When we actually start doing the financial statements, then we can talk about what we call the T accounts, i.e. we're talking about the trial balance, the financial statements, the balance sheet, all of those different accounts. We'll talk about them once we are done with the theory part, which we're going to do in our next lecture. So for those that want to read ahead, I would advise go through what we did today. Then you can read unit number 1, specifically the theoretical part. That is what we're going to focus on in our next lecture. Once we're done with the theory part, then we start doing the actual financial statements, i.e. how do you prepare a balance sheet, how do you prepare an income statement, how do you prepare a statement of cash flow, and whatnot. But you have seen the way that I teach in terms of I will give you guys a little bit of homework here and there. The reason why I would want you guys to do this homework is so that you can practice, because accounting, statistics, mathematics, those things need you to practice. If you don't practice, you're going to have a problem, because there are calculations. So you need to also at least practice here and there to see if you're grasping the concepts, so that when you attend the lectures, you can ask the questions that you might have for what we have done. I don't know if there are any questions for what we have done today. Feel free to ask me. Are there any questions? I believe the silence means everyone is happy. That's good. That's good. I like it when everyone is happy. Someone says, when is the next class? So the next class is supposed to be on Thursday next week. But however, if I see it's necessary, we can do it earlier, because it's a free class, but it's supposed to be on Thursday next week. But if I see it necessary, maybe I can ask you guys to meet. I'm not sure, because this weekend I'm traveling, so I don't want to make a promise that I will not meet. But if I see it necessary, I will just post in the different groups that, guys, let's come and join together with another free class or something like that. But for planning purposes, you can plan with Thursday next week. Then the homework will be in the notes. I'm going to send you guys the notes. I'm also going to send you guys the link to the video of the lecture. So the recording, you will receive it. I think maybe give me an hour or so to just upload it. And then the notes that I send you in the class in PowerPoint, they will include the homework of what we're doing. If you have any challenges, guys, yes, I know I might be a very busy person. I might not answer immediately, but always post your question. You can post them in the group, or you can wait for the lecture and ask them in the lectures. Let's make the lectures as interactive as possible so that everyone is actually benefiting from what we're doing. Then in addition to this, I'm sure most of you already know, we have other lectures that we do. We've got lectures for economics, lectures for functional areas of management and whatnot. I will post the respective dates for the free lectures. They will happen next week. So I'll post the respective dates during, I think during the weekend, I'll post the respective dates so that those that are interested can also join through. So I hope you all have a pleasant evening. If there's nothing else, I declare this meeting closed.
Thank you, James.
Thank you. Thank you.
Thank you.
You're welcome.
Thank you. Thank you.